Have you ever wondered how money came to be? Like, who decided to trade cows and chickens for coins, right? And now we're here, swiping cards, scanning QR codes, and even trading invisible internet coins. This course is going to be as much fun as a treasure hunt. So, grab your pen and paper, and let's get this money party started. And before we get started, make sure to subscribe to our channel, because we know you're a smart and want to be smarter kind of person. This course is broken into 10 units, and each unit has 5 simple chapters. Let's start with Unit 1. In this chapter, we will explore the concept of money and its functions. Money is like a universal tool that helps us exchange goods and services with each other. It's like a language that everyone understands when it comes to buying and selling. Starting with the very basics, what is money? Think of money as a special kind of tool that we use to buy things. Just as we use a hammer to build a house, we use money to buy things we need or want. Money comes in different forms, such as coins and banknotes, but it can also be digital, like when you pay for something using a mobile payment app. Functions of money. Money has 4 important functions, just like a multi-tool has different functions for different tasks. Medium of exchange. Money acts as a medium of exchange, just like a bridge connecting 2 places. It helps us trade goods and services without having to resort to bartering. For example, if you want to buy a toy, you give money to the seller, and they give you the toy. Money makes this exchange process easier and more efficient. Unit of account. Money serves as a unit of account, similar to a ruler that helps us measure things. It provides a standard way to measure and compare the value of different goods and services. For instance, if you see a toy priced at $10 and a book priced at $20, you know that the book is more expensive. Money helps us make these comparisons and decisions. Store value. Money acts as a store of value, like a piggy bank where you can save your money for future use. When you receive money as a gift, you can keep it safe and use it later to buy something you want. By keeping money, you can store your purchasing power for the future. Standard of deferred payment. Money acts as a standard of deferred payment, just like a promise you make to pay back a favor. It allows us to make purchases on credit or take loans, knowing that we can pay back the borrowed money in the future. For example, if you want to buy a car but don't have enough money, you can take a loan from a bank and pay it back over time. Let's explore how people used to trade goods and services before the invention of money. This system, known as the barter system, had its limitations. Barter system. Imagine a time when money didn't exist. People had to directly exchange goods and services to get what they needed. For example, if you were a farmer and needed shoes, you would have to find a shoemaker who needed your crops. You would then negotiate a trade, exchanging your crops for the shoes. This is how the barter system worked. Limitations of barter system. While the barter system allowed for basic trade, it had several limitations that made transactions difficult and inefficient. Lack of double coincidence of wants. To make a trade in the barter system, both parties had to find someone who wanted what they had and had what they wanted. This double coincidence of wants was often challenging to achieve. For instance, if the shoemaker didn't need crops, the farmer would have to find someone else who wanted crops and had shoes to offer. Indivisibility of goods. Some goods were difficult to divide or split for trade. For example, if a farmer wanted to exchange a cow for a small item, it was not practical as the cow couldn't be easily divided. This lack of divisibility made certain trades impossible. Lack of a standard measure of value. Without money, it was challenging to determine the relative value of different goods. For example, how many bushels of wheat should be exchanged for a pair of shoes? The absence of a standardized measure of value made fair trades difficult. Difficulty in storing value. Certain goods, like perishable food items, couldn't be stored for a long time. This made it challenging to save value for future transactions. Additionally, the barter system lacked a secure way to store wealth. Let's explore how people transitioned from the barter system to using commodity money, which had inherent value and made trades easier. Commodity money. Commodity money is a type of money that has intrinsic value because it is made from a valuable commodity itself. Examples of commodity money include salt, cattle, shells, and even precious metals like gold and silver. Advantages of commodity money. Using commodity money had several advantages over the barter system. Inherent value. Commodity money had value on its own, making it easier to determine the relative worth of goods. For example, a piece of gold could be exchanged for a certain quantity of wheat or other goods. Divisibility. Commodity money was often divisible into smaller units, making it easier to facilitate transactions. For instance, gold or silver could be melted down and divided into smaller coins or pieces. Portability. Commodity money was relatively easy to carry and transport compared to bulky goods in the barter system. For example, gold and silver coins were portable and convenient for trade. Durability. Commodity money, such as shells or precious metals, was durable and didn't perish over time. This allowed it to be used as a medium of exchange without the risk of spoiling or losing value. So how metallic money, specifically gold and silver, became widely accepted as a form of currency? Metallic money. Metallic money refers to coins made from precious metals like gold and silver. These coins were stamped with specific values and became widely accepted as a medium of exchange. Advantages of metallic money. Metallic money offered several advantages over commodity money. Standardization. Coins had a standardized weight, size, and purity, ensuring uniformity and eliminating doubts about their value. This standardization made trade and transactions more efficient. Wide acceptance. As coins gained recognition and acceptance, they became a trusted medium of exchange across regions and societies. People could rely on the value of the metal in the coins. Trust and confidence. Metallic money carried inherent value and was difficult to counterfeit. This instilled trust and confidence in its use as a medium of exchange. Let's explore the transition from metallic money to paper money and the concept of fiat currency. Introduction of paper money. To address the challenges of carrying metallic money and facilitate larger transactions, people started using paper money. Paper money represented a claim on the underlying metallic money stored by banks. Fiat currency. Fiat currency is a form of money that is not backed by a physical commodity like gold or silver. Instead, its value is based on the trust and confidence placed in the issuing authority, usually the government. Advantages of paper money and fiat currency. Portability and convenience. Paper money is lighter and easier to carry than metallic coins, making it more convenient for everyday transactions. Divisibility and standardization. Paper money can be easily divided into smaller units and standardized across denominations, allowing for precise value representation. Expansion of money supply. Fiat currency enables the expansion of the money supply to meet the growing needs of a modern economy. Central banks can regulate the money supply by printing more money or withdrawing it from circulation. Confidence in the issuing authority. Fiat currency relies on trust and confidence in the government or central bank that issues and manages it. When people believe in the stability and integrity of the issuing authority, the currency holds its value. So how money is measured and standardized? Monetary units. Different countries have their own monetary units, such as the US dollar, euro, Indian rupees, or Japanese yen. These units provide a standard way to measure the value of goods and services within their respective economies. Exchange rates. Exchange rates determine the value of one currency in relation to another. For example, if the exchange rate between the USD and euro is $1 equals 85 cents, it means that $1 can be exchanged for 0.85 euros. Standardizing money. In the past, currencies were often backed by gold or pegged to a fixed exchange rate. This was known as the gold standard. However, most currencies today are fiat currencies, where their value is not directly tied to a physical commodity. Instead, their value is determined by market forces and the confidence placed in the issuing authority. Coins. Coins are metallic discs issued by a government or central authority. They have a standardized shape, size, and weight, making them easily recognizable and universally accepted. Coins come in different denominations, representing different values. For example, a quarter in the United States represents 25 cents, while a £1 coin in the United Kingdom represents £1. Banknotes. Banknotes, also known as paper money or bills, are paper or polymer-based notes issued by the government or central bank. They represent a specific monetary value and serve as a widely accepted medium of exchange. Banknotes come in different denominations, just like coins, and often feature important symbols, historical figures, or landmarks of the issuing country. Advantages of physical money. Tangibility. Physical money can be held, counted, and physically exchanged, providing a sense of security and familiarity. Widely accepted. Coins and banknotes are generally accepted as a form of payment in most places, allowing for convenient transactions. Accessibility. Physical money is easily accessible to individuals who may not have access to digital payment methods or banking services. No dependency on technology. Physical money does not rely on technological infrastructure or electricity, making it usable even in areas with limited technological resources. Electronic transfers. Electronic transfers refer to the movement of money from one bank account to another electronically. This can be done through various electronic systems, such as online banking platforms, mobile banking apps, or wire transfers. Advantages of digital money. Convenience. Digital money allows for instant transactions without the need for physical presence or handling of cash. Speed. Electronic transfers are usually faster than traditional methods, enabling quick and efficient money transfers. Record-keeping. Digital transactions leave a digital trail, providing easy access to transaction histories and facilitating financial record-keeping. Security. Electronic transfers often incorporate encryption and security measures to protect against unauthorized access and fraud. Checks. Checks are a form of representative money issued by an individual or organization that instructs a bank to pay a specified amount of money from the issuer's account to the recipient. Checks provide a convenient and secure way to transfer funds without the need for physical cash. Money orders. Money orders are prepaid certificates issued by financial institutions or postal services. They represent a specific amount of money and can be used as a payment method, especially when personal checks or electronic transfers are not accepted or accessible. Traveler's checks. Traveler's checks are pre-printed, fixed-amount checks that can be used as a convenient and secure method of payment while traveling. They offer a safer alternative to carrying large amounts of cash and can be easily replaced if lost or stolen. Cryptocurrencies. Cryptocurrencies, such as Bitcoin, Ethereum, and Litecoin, are decentralized digital currencies that operate on a technology called blockchain. They are not issued or regulated by any central authority, such as a government or central bank. Advantages of cryptocurrencies. Security. Cryptocurrencies use advanced cryptographic techniques to ensure secure transactions and protect against fraud. Privacy. Cryptocurrencies provide a level of privacy as transactions are pseudonymous and do not require the disclosure of personal information. Borderless transactions. Cryptocurrencies facilitate cross-border transactions without the need for currency conversion or intermediaries, potentially reducing transaction costs and delays. Potential for innovation. The underlying blockchain technology of cryptocurrencies has the potential for various applications beyond currency, such as smart contracts and decentralized applications. Central banks. Central banks are financial institutions established by governments to oversee monetary policy and regulate the financial system. They act as the bank of banks and are responsible for maintaining stability and promoting economic growth. Money supply. The money supply refers to the total amount of money in circulation within an economy. It includes physical currency, coins and banknotes, and demand deposits held in banks. Controlling money supply. Central banks play a crucial role in controlling the money supply through various monetary policy tools. Open market operations. Central banks buy or sell government securities, bonds, in the open market to influence the money supply. When they purchase securities, they inject money into the economy, increasing the money supply. Conversely, when they sell securities, they withdraw money from the economy, reducing the money supply. Reserve requirements. Central banks establish reserve requirements, which mandate the amount of funds banks must hold as reserves. By adjusting these requirements, central banks can affect the amount of money that banks can lend and create, thus influencing the overall money supply. Discount rate. Central banks set the discount rate, which is the interest rate at which commercial banks can borrow from the central bank. By increasing or decreasing this rate, central banks influence the cost of borrowing for banks, which impacts their lending activities and, consequently, the money supply. Open market operations. Open market operations involve the buying or selling of government securities, bonds, by the central bank. When the central bank buys bonds, it injects money into the banking system, increasing the money supply. Conversely, when it sells bonds, it removes money from the system, decreasing the money supply. Reserve requirements. Reserve requirements refer to the portion of a bank's deposits that it must hold in reserve and cannot lend out. By increasing reserve requirements, the central bank restricts the amount of money that banks can lend, thereby reducing the money supply. Conversely, decreasing reserve requirements gives banks more freedom to lend, increasing the money supply. Discount rate. The discount rate is the interest rate at which commercial banks can borrow funds directly from the central bank. By lowering the discount rate, the central bank encourages banks to borrow more, which increases their lending capacity and expands the money supply. Conversely, raising the discount rate makes borrowing more expensive, leading to a decrease in lending and a contraction of the money supply. Forward guidance. Central banks also use forward guidance, which involves communicating their future monetary policy intentions to guide market expectations. By providing clear signals about future interest rate decisions or other policy actions, central banks can influence borrowing costs, spending, and investment decisions, thereby impacting the money supply. Monetary base. The monetary base, also known as high-powered money or the monetary aggregate, represents the total amount of physical currency in circulation plus reserves held by banks at the central bank. Money multiplier. The money multiplier is a concept that illustrates how changes in the monetary base can lead to a multiplied impact on the money supply. It depends on the reserve ratio, which is the percentage of deposits that banks must hold in reserve. Money creation process. When the central bank injects money into the banking system through open market operations or other means, banks can use these funds to make loans. As banks lend money, the borrowed funds are deposited into other bank accounts, increasing the overall money supply. This process can continue, with each new deposit serving as a basis for further lending, resulting in a multiplied expansion of the money supply. Impact of reserve ratio. The reserve ratio plays a crucial role in determining the extent of the money multiplier effect. A lower reserve ratio means that banks can lend a larger portion of their deposits, leading to a higher money multiplier and a larger increase in the money supply. Conversely, a higher reserve ratio reduces the lending capacity of banks, resulting in a smaller money multiplier and a more limited expansion of the money supply. Central bank independence. Central bank independence refers to the autonomy of the central bank in formulating and implementing monetary policy decisions without undue interference from the government or political pressures. Independence allows central banks to make decisions based on economic considerations rather than short-term political interests. Benefits of central bank independence. Credibility. Central bank independence enhances the credibility and effectiveness of monetary policy. It demonstrates a commitment to price stability and reduces the risk of political influence undermining sound monetary decisions. Stability. Independent central banks can pursue long-term goals, such as maintaining price stability and promoting economic stability, even in the face of short-term political pressures. Central bank accountability. While independence is important, central banks are still accountable to the public and their respective governments. Accountability ensures transparency, responsible decision-making, and responsiveness to economic conditions. Accountability mechanisms. Central banks are accountable through various mechanisms, such as reporting. Central banks publish regular reports on their activities, economic outlook, and policy decisions, providing transparency to the public and policymakers. Communication. Central banks communicate their policy decisions, objectives, and rationale to the public, allowing for public scrutiny and understanding of their actions. Oversight. Governments and legislative bodies may have oversight functions, ensuring that central banks operate within their defined mandates and objectives. International monetary system. The international monetary system refers to the framework of rules, agreements, and institutions governing monetary interactions between different countries. Central banks play a significant role in maintaining stability and cooperation within this system. Exchange rates. Central banks monitor and intervene in foreign exchange markets to influence exchange rates, ensuring stability and mitigating excessive volatility that could disrupt trade and economic activities. International cooperation. Central banks engage in international cooperation to address global financial stability issues. They share information, coordinate policy actions, and provide support during times of financial crises to maintain stability in the global financial system. International financial institutions. Central banks often collaborate with international financial institutions, such as the International Monetary Fund, IMF, the World Bank, and regional development banks, to address systemic risks, provide financial assistance, and promote economic growth and stability on a global scale. Monetary units. Monetary units are standardized forms of currency used within specific countries or regions. They provide a common medium of exchange, allowing individuals to compare and trade goods and services. Some of the examples of monetary units are United States dollar or USD, Euro, Japanese yen, British pound, Canadian dollar, Australian dollar, Swiss franc, Chinese yuan, Indian rupee, Brazilian real. Importance of monetary units. Monetary units simplify economic transactions by providing a common standard for measuring value. They allow individuals to express prices, wages, and financial transactions in a consistent and easily understandable manner. Exchange rates. Exchange rates represent the value of one currency relative to another. They determine how much of one currency is needed to purchase a certain amount of another currency. Factors influencing exchange rates. Exchange rates can be influenced by various factors, including economic factors, interest rates, inflation rates, and economic growth. Market forces, supply and demand dynamics in foreign exchange markets. Political stability. Political events and stability can impact exchange rates. Speculation, expectations and speculations about future currency movements. Impact on international trade. Exchange rates play a crucial role in international trade. Exporters. A weaker domestic currency makes exports more competitive and attractive in foreign markets. Importers. A stronger domestic currency reduces the cost of imported goods and makes them more affordable for domestic consumers. Foreign direct investment. Exchange rates affect the attractiveness of investing in different countries, as they impact the potential returns on investment. Standardizing money. Standardizing money involves defining the value of a currency in relation to a specific asset or commodity. This provides stability and consistency in measuring value. The gold standard. The gold standard was a monetary system in which the value of a currency was directly linked to a specific amount of gold. Under this system, paper money or banknotes could be exchanged for gold at a fixed rate. The gold standard provided stability but had limitations due to the limited supply of gold. Transition to fiat currencies. Fiat currencies are currencies that have value because the government declares them as legal tender. They are not backed by a physical commodity but rely on the trust and confidence of the users. Most currencies today are fiat currencies, allowing central banks to have greater flexibility in managing monetary policy and adapting to changing economic conditions. Flexibility. Fiat currencies can be easily adjusted to respond to economic changes and support monetary policy goals. Independence. Fiat currencies provide central banks with greater control over monetary policy without being constrained by a fixed exchange rate with a increased stability. Fiat currencies can be better managed to maintain stability and mitigate the effects of economic shocks. That concludes our first unit on money. Stay tuned for the next video where we'll continue our discussion about money. Don't forget to subscribe so you won't miss out.